Good morning and afternoon, everyone. Thank you for joining us and welcome to our Credit Union's Growth, Mergers, and Strategy event here at Fasken's. My name is Tara Newman and I am Counsel in Fasken's Financial Services Practice Group. It's my pleasure to be joined today by Koker Christensen, a partner at Fasken's and co-leader of our Financial Services Group, and our guest speakers, Victoria Mainprize, Vice President, Policy and General Counsel of the Canadian Credit Union Association, and Mehrdad Rastan, Executive Vice President, Credit Union and Insurance Prudential of the Financial Services Regulatory Authority of Ontario. I've heard it said many times this week that we live in interesting times. And I started my day off today with probably the same way you do, which is very much listening to the news over a cup of coffee. There were two stories that caught my attention, particularly thinking about today's event. One was the importance of thinking about how we can break down interprovincial trade barriers and improve national commerce. The flip side was all about thinking about the political uncertainty that you might have heard about lately, and the importance of doubling down on supporting our communities and thinking about what can we do locally to help. Now, two completely different divergent strategies, but potentially both very relevant to the credit union sector. We have a full agenda today. We're going to dive deeper into the details around these strategies and themes, and we hope that what you can hear helps you navigate what's coming in 2025 and beyond. Because our agenda is pretty full, we're going to hold questions until the end, please, and then happy to discuss it with the panel at that point in time. Before we kick things off, though, I'd be remiss if I didn't mention a few technical logistics that are outlined on your screen, particularly for those of us that are joining us online from across Canada. I'd like to draw your attention to the survey and the CPD certificates points. There will be QR codes that appear on your screen at the end of the event that you can use to fill in our survey and obtain Ontario or Quebec CPD certificates. If you don't have an opportunity to obtain your certificate today, they will be sent to you within the next week. Now, on to our presentations. First, Victoria will be speaking about regulatory trends, mergers, and impediments to growth that she's seeing through her work at the Canadian Credit Union Association. Victoria.
Thank you very much, Tara. So as Tara mentioned, I'm going to talk about regulatory trends, some impediments to mergers and to growth that we're seeing. And I'm going to talk about four things, really. First, what we're seeing in the sector generally. Secondly, what we're seeing in terms of mergers between credit unions within the same province. Third, what we're seeing in terms of mergers between federal and provincial credit unions. And finally, what options there are for operating outside one's province or merging outside one's province. Before I start, however, I'm going to give a little bit of information about the credit union sector, although I recognize that the vast majority of this audience knows very much about the credit union sector. So I'll start with why are credit unions important. And one of the main reasons that credit unions are important are that they provide really good competition for the banking sector, which is dominated by 6 domestically important banks. The other is that they're rooted in their communities and pay huge attention to the members that they serve, ensuring that their needs are met. Credit unions are community-based alternatives to banks. They provide the same financial products, services to over 6.1 million Canadians. And we have 185 credit unions right now that operate from 2,214 locations nationwide. And in 380 Canadian communities, they are the only financial institution. Credit unions are small and medium-sized enterprises overall that collectively control approximately $313 billion in assets, representing 6.4% of domestic assets held by all Canadian deposit-taking institutions. And importantly, they employ almost 30,000 Canadians from coast to coast. All credit unions are required to belong to a provincial or regional central, which acts as a central banking facility and a provider of key services, including liquidity management. So overall, credit unions within their communities offer similar services to banks, but with fewer fees, lower loan rates, and higher savings rates. And unlike banks, which exist to generate profit for shareholders, credit unions generate profits for people. They generate profits to support their members and support their communities. For over 2 decades, credit unions have been ranked the best for customer service among all financial institutions in Canada by the Ipsos Financial Service Excellence Awards, which reflects their dedication to profits for people. So now, what are we seeing across the sector? In the financial sector generally, and in particular the credit union sector, we're seeing a number of trends that are affecting credit union profits and margins, which in turn impact growth and the ability for credit unions to serve their members. The first is regulatory expectations are increasing. There's a greater focus on governance, long-term strategy, and resolution planning. As cooperative democratic institutions, credit union boards come from their communities. And ensuring that those boards are able to effectively guide and steer credit unions through these challenging times is a key focus for many regulators and for the sector itself. Across the country, and I imagine Mehrdad will speak to this a little bit, regulators are also embracing principles-based regulation, which, while very beneficial for the sector in the long run, has been challenging for some smaller credit unions who are more used to a prescriptive check-the-box type of approach. It also requires these credit unions to spend a lot more money on regulatory compliance. Costs related to cybersecurity breaches, fraud, scams have increased exponentially over the past few years. They're a ballooning epidemic, and the Canadian Anti-Fraud Centre estimated that Canadians lost $567 million in 2023, a nearly 50% increase to what was lost in 2021. And the Canadian Anti-Fraud Centre also predicts that, in fact, because only 5 to 10% of the population reports the fraud that they've been subject to or the scams they've been subject to, the true losses are actually closer to $5.7 to $11 billion annually and growing. Those losses not only impact financial institutions in terms of direct costs, but also reputational damage. And there are also concerns that the risk these costs will increase, and also that liability may start flowing more to financial institutions. As a result of both of these things, the increase in regulatory expectations and the increase in costs related to fraud, technology costs are also increasing. And customers, especially young ones, actually want effortless, frictionless digital services without foregoing strong protections for their personal and financial information. So it's costing credit unions more and more to attract new members, especially new and younger Canadians. And it's also costing them a lot more to attract talent, the talent that's necessary to meet these new challenges. Unfortunately, as all of these cost pressures are increasing and trending upwards, what's trending downwards are margins. And this is exacerbated by a current high interest rate environment. So unpacking these pressures.
I'm just going to ask you to pause for one moment. We're getting some feedback from folks that are joining us online that they're having a few technical glitches. Our technical team has asked for everyone online if you could please refresh your online browser, and that should hopefully fix the feedback issue that you may be experiencing. Thanks very much. Sorry.
No problem. So if any of you missed what I just said, it's the next part that's more important. So what are we seeing across the financial sector? As mentioned, regulatory expectations are increasing. And there's significant costs for financial institutions, credit unions, other financial institutions generally. Regulatory compliance is a significant cost, and unfortunately, regulatory burden is one of the areas where Canada appears to be a world leader. So the recent CD Howe report identified that Canada's regulatory burden has increased significantly over the past decade, resulting in significant compliance costs and decreased competitiveness for financial institutions generally. And one reason for this is that regulatory bodies have focused heavily on stability and consumer protection, which has had a negative impact on innovation and market efficiency. The second is that provincial credit unions are not only regulated at the provincial level, but they're actually subject to a patchwork of regulation that includes a significant amount of federal regulation. The compliance burden in particular for anti-money laundering and anti-terrorist financing is very high, and the growing costs of compliance in this area can be punitive for smaller institutions. The financial sector as a whole is also dealing with new entrants, meaning that credit unions no longer just compete with banks, they also have to compete against these new entities that are actively looking to challenge and replace traditional financial institutions. With their new operating models, their digital platforms, and their technology, these new entrants are attracting huge numbers of new clients. Many of them are the new and younger Canadians that credit unions themselves are trying to attract. Linked to this, we're seeing an aging of credit union membership. Although an aging base is not unique to credit unions, the impact on our sector has been significant. While a little over 28% of the customer base of Canada's largest banks is over age 65, for credit unions, that represents 40% of their membership. Our sector also has a much smaller portion of the younger population. And in turn, as you can see, all of this is impacting credit union efficiency, where credit unions typically have much higher efficiency rates than banks. So what are credit unions to do? How can they grow and meet these pressures? And how can they continue to serve their members and communities? We know that scale is the game, and scale is the only thing that really will save institutions at this time. So in many cases, credit unions are looking to grow, and they're looking to merge and consolidate. And we have a long history of this in the credit union sector, and research done by the Canadian Centre for the Study of Cooperatives shows that credit unions that merge grow faster than those that don't. And that's not just because of the actual merger and the year of the merger. It continues for years after. And in many cases, it's because of the efficiencies created by the merger. All of this consolidation is reshaping the credit union sector. And each year, for a number of decades, the trends towards mergers and consolidation has resulted in a significant reduction in the number of credit unions. In the last 5 years alone, the number of credit unions has decreased from 230 to 186. And as further identified by the Canadian Study for the Centre of Cooperatives, mergers occur between credit unions of all types. However, the greatest number occur between medium-sized credit unions and small credit unions, with very few happening between large credit unions and small credit unions. In other words, large credit unions are increasingly not interested or able to merge with much smaller ones. Collectively, this consolidation has resulted in a sector with not just fewer, but also significantly larger credit unions, a trend that continues to increase as the mid-sized credit unions merge and the large credit unions get bigger. This means that it's going to be harder and harder for smaller credit unions to find merger partners. We see this trend continuing into the future, with the result that there will be eventually a few very large credit unions dominating the sector and a decreasing number of smaller ones that will find it harder and harder to grow, serve their members, and even survive. The other thing we're seeing as a result of this consolidation is significant concentration within provinces, many of which have one or two very large credit unions that dominate their sector and represent a significant portion of sector assets. This has three important implications. The first is that the large credit unions in each province will start to run out of merger partners within their province, and they're going to need to seek other avenues for growth. The second is that the very large credit unions are starting to become provincially systemic institutions, creating huge risk to the province in the event that one of them fails, especially in the jurisdictions that have unlimited deposit insurance. And finally, a few large credit unions that now hold a significant portion of provincial assets often dominate the boards of the centrals. Traditionally, the centrals provided a number of services, back office supports to smaller credit unions, and with fewer smaller credit unions on central boards, we're starting to see a number of them start slimming down. And the slimming down means that they're abandoning a number of the supports that they previously offered to small credit unions. In turn, also, we're seeing a reshaping of the meaning of cooperation among cooperatives or cooperation among credit unions, one of the 7 tenets that drives our sector. Driven by the need to be profitable, large credit unions are making decisions now to support their long-term prosperity and their needs of their members, and they're less willing to expend the time, the cost, and the effort to merge with smaller credit unions. This means that smaller credit unions need to and are also looking at options to grow. So, one of the main options, and I know that Koker will talk about this later, is intra-provincial mergers, so mergers within a province. Currently, there are two ways for credit unions to merge. One is within the province. The other is mergers between a provincial credit union and a federal credit union. Overall, the process for intra-provincial mergers, or mergers between credit unions within the same province, is relatively straightforward. And in each jurisdiction in Canada, the process varies slightly, but essentially, it includes the credit unions entering into an amalgamation agreement, obtaining regulatory approval for the agreement, obtaining member approval, and then merging. It's a very well-established process, and over the past few years, it's resulted in a number of very, very successful credit union mergers. In many cases, we're also seeing that it's the same credit unions that are entering into the mergers, and we're also seeing mergers with multiple credit unions happening simultaneously. So that brings us to federal-provincial mergers. This is the other option for credit unions that want to grow beyond their provincial borders. Since 2012, the credit union sector has had access to the federal regime, and provincial credit unions are able to continue into the federal sector. However, to date, only 3 credit unions have achieved federal continuance, which means that options for mergers among those federal credit unions themselves are very limited. So the Bank Act, under which federal credit unions are regulated, offers 2 potential avenues for growth. One is something called the dual application process, in which the provincial credit union first, I keep forgetting my slides, in which the provincial credit union first needs to continue federally. Once it's continued federally, it immediately amalgamates with the existing federal institution. This has many benefits for the smaller provincial credit union, including the ability to serve their members across Canada and to grow membership across Canada under their new merged entity, and to leverage the existing policies, technology, and systems and processes that the existing federal credit union already has in place. This is a relatively untried approach, and the first combination of this sort, which is taking place right now between Innovation Federal Credit Union and ABCU Credit Union, or ABCU in Alberta, it's currently underway. However, I understand it has not been without its challenges. So what is the second option? The second option is an asset sale, where the provincial credit union sells its assets and liabilities to the federal credit union, and the federal credit union then essentially absorbs the provincial credit union. Although in theory, this should be a fairly straightforward and easy process, there are actually a number of barriers to this, including need for amendments to the Bank Act, the CDIC Act, the Income Tax Act, and provincial statutes across the country to permit the sale of the provincial credit union assets to the federal credit union in exchange for membership shares in the federal credit union. In the meantime, without those legislative changes, this is essentially not a viable option. So this brings us to the final topic, which is interprovincial options. What can credit unions do if they want to grow beyond their borders? So many credit unions have asked about operating in another jurisdiction or actually merging interprovincially. The first is theoretically viable in some jurisdictions, but it's completely untested and it's uncertain. So not only does provincial legislation vary across the country, in which some actually forbid extra-provincial credit unions from operating in their jurisdiction, while others will permit it, provided that the external or the extra-provincial credit union operates under a license and that the relevant provincial governments have entered into an agreement. To date, none of that has happened. There may also be conditions about deposit insurance, and again, because this has never been tried and because there is no clear process for this, at the moment, it doesn't seem to be a viable option. And the second The second is also not feasible, and it's an area that a lot of credit unions are asking about, in particular small credit unions, and that's, can you merge across provincial borders? Unfortunately, it's not possible at the moment, and potentially may never be possible. Canadian legislation doesn't allow amalgamations or mergers between entities that operate in two different jurisdictions. They're considered to be two different types of entities, and you can only merge entities of the same type. So in other words, for a credit union in one province to merge with a credit union in another province, the typical approach would be that one of the credit unions would need to first continue into the other provincial jurisdiction, and then they could merge. Again, this isn't something that's possible at the moment, and it's potentially something that wouldn't even be attractive. So, until these are made more viable, we are left with provincial, intra-provincial mergers and mergers between federal and provincial credit unions, both of which have their challenges. And with that, I'll pass it over to Koker to talk about the merger process. Sorry, thanks.
Thanks, Victoria. So I'm going to talk about M&A in more detail and key considerations for credit unions. So what you see on the first slide is a high-level overview of the M&A process, and this also functions as a rough agenda for what I'm going to talk about. So it starts with initial steps, developing the business case, figuring out the deal structure, some initial legal agreements relating to this, due diligence process, then drafting and negotiating a transaction agreement, then a couple of the hurdles that you have to go through. After that are getting regulatory approval as well as member approval, and then you move to the closing. So a lot of these steps are pretty similar to what you would see in M&A generally, not limited to the credit union sector. But there are some aspects of credit union M&A that are different, that are unique, and I'm going to emphasize those throughout my discussion. So, talking about the initial steps. So, at the risk of stating the obvious, there needs to be a clear business case for the transaction, and this is one of the things that's going to be one of the first things that a credit union is going to have to grapple with. So normally, the decision to enter into a transaction like this starts with some sort of decision by the board of directors that it needs to that it wants to do a transaction, right? So if it's a smaller credit union, a decision that it needs to find a larger partner, or if it's a larger credit union, a decision that this is an avenue of growth that they want to explore. The other question, of course, is not just do you want to enter into a business combination, but is the credit union you've identified as a dance partner, is this the right person to do it with? And so these are some key things that are going to need to be thought about at the outset. And obviously, the board of directors is going to be critical in making these decisions. So the next bullet here is about deal structure. So one of the things that you're going to have to figure out is what the right transaction structure is. This was touched on earlier, but there's basically two options for credit unions. You can either do an amalgamation or you can do an asset transaction. This is one of the areas in which credit union M&A differs from M&A for ordinary business corporations, because you obviously can't have a buyer acquire the shares of a target credit union because they're cooperative entities. And then in terms of the initial legal documentation, there would typically be a letter of intent that would set out the mutual intention of the parties to explore the transaction, maybe set out some of the key terms about how it's going to work. And again, it's important to make sure before you go too far down the road that there is an alignment on the basics of how the transaction is going to work. And then a non-disclosure agreement would be entered into, and this would be something you'd enter into to facilitate the sharing of information as part of the due diligence process. So, what are the key considerations when you're looking at a transaction? So, a lot of these are going to be discussed in the following slides in more detail, but I'm going to quickly touch on these sort of four big buckets that are here, right? So, the first one is considerations around governance and scope of the transaction. So, figuring out what assets and liabilities are supposed to be in the deal. Are there assets and liabilities that are supposed to be outside the deal? And what does the credit union look like on the other side of this transaction? What's going to be the name, the brand? Are there going to be any changes to how the business is operated? Are there going to be any changes to the board of directors? What's the management composition going to be? These are obviously key considerations to think about at the outset. The next category is financial. So there's questions around how you're going to value the assets, what the purchase price is going to be, and then there might be some post-closing adjustments. I'll get into this in a bit more detail, but this is an area in which there are differences from a traditional M&A transaction. In a normal M&A transaction, certainly in a private company M&A transaction, you have a buyer buying either the shares or assets of a seller or target and paying a purchase price, and that would often be a cash purchase price. In credit union M&A, it's really more the combination of balance sheets. And in my experience, whether it's an asset deal or an amalgamation, that's really what it is that it's the putting together of the two balance sheets in one larger credit union after the transaction. I will get into that in a bit more detail afterwards. So key hurdles. These are just some of the things you're going to have to get through to get to the closing. So there's going to have to be due diligence. You might have to deal with third-party consents if you are either assigning contracts from one credit union to another, or in the case of an amalgamation, there may be third-party consents required because of a change of control. There are going to be regulatory approvals, and there are going to be member and shareholder approvals. The last bucket here is about people. And so there's some important considerations here, right? So number one, you have to make sure that the people who have the knowledge of the business are involved in the process, in order both as part of the due diligence process, but also in terms of making sure that the post-closing planning can be effectively done. One of the big changes that needs to be thought about is what the impact on employees is. So if you have, for example, an asset transaction, you will have employees of the selling credit union moving over to the buyer credit union. And so the way that would typically be done is that they would be offered employment on substantially equivalent terms, but it is a change, and it can be a significant change. So that's something that needs to be thought about. Post-closing integration. Again, who's going to be involved in this? Because once you close the deal, there's still a lot of work to be done, and you got to figure out, who are the people that are going to be involved in that, and you got to make sure that if there are people from the selling credit union that are going to be critical to that they are going to be there at that time. And then, in the case of an asset transaction, what you'll have is a selling credit union that has few or no assets potentially after the transaction. But there's still going to be some cleanup that needs to be done to deal with any remaining assets and liabilities, and then to carry out the dissolution. And you got to figure out who's going to be in place to do that work. So, doing a bit of a deeper dive on deal structure. So, as discussed, there's the two potential transaction structures. You can have an asset transaction, or you can have an amalgamation. So this is just a high-level comparison of the two structures. So in each case, you'll have a transaction agreement. It'll be a slightly different agreement, obviously, reflecting the structure. One of the key differences is the treatment of assets and liabilities. So in an amalgamation, what you have is all the assets and all the liabilities of each of the amalgamating credit unions becoming the assets and liabilities of the amalgamated credit union. So the two really just become one. In an asset transaction, you have you can select which assets move from the seller to the buyer, and you can select which liabilities move from the seller to the buyer. So what that means is there is at least potentially the opportunity to leave some things behind in the seller. Now, of course, the thing to recognize is that whatever is left behind is going to have to be dealt with. So it's not quite as simple as saying if there's anything that's undesirable, leave it behind, because that's going to need to be dealt with one way or another. But there is the flexibility to do that. So that's a key difference. In both cases, the end result is presumably going to be that the members of both credit unions are the member of the amalgamated credit union or the members of the buyer. But the legal process by which that happens is somewhat different. And then I mentioned this point before, but in an amalgamation, there is no credit union that's left behind afterwards. You just have the two becoming one. In an asset sale, you do have the seller continuing to exist as a separate legal entity, and that will need to get dealt with in some way. The last point I want to flag is that there can be some differences in terms of the approvals that are required. So in an amalgamation, each credit union is going to need member approval. If it's an asset deal, depending on the size of the transaction, it may be that only the seller needs needs to get that member approval. I mean, it's presumably going to be all or substantially all of the seller's assets, but if it's a larger credit union buying a smaller credit union, it may be a relatively small percentage of the assets for the larger credit union, and therefore it may not need member approval. So I want to talk about what some of the key terms in the transaction agreement are going to be. And again, a lot of these would be common to any M&A transaction, but there are some important differences for credit unions. So in terms of the purchase price, so what I'm now talking about an asset transaction where the buyer is buying assets and assuming liabilities from the seller. So the typical structure, in my experience, is going to be that the buyer is purchasing the purchased assets, which are going to include loans and real estate and other assets that the seller has. And they're going to satisfy the consideration or the purchase price in really two ways. One is they're going to assume liabilities, so deposits and other liabilities. And the other is that they're going to issue member shares to the members of the seller so that the members of the seller become members of the buyer. But what there's not, in my experience, typically, is there's not some cash purchase price that goes to the owners of the selling credit union, right? Instead, you really have, even though it's an asset deal, it's akin to an amalgamation from a balance sheet point of view, that you have the two balance sheets being combined. You're then going to have to identify what the purchased assets are, what the assumed liabilities are, and any that are excluded. And as discussed, anything that's excluded is still going to have to be dealt with after the closing. There will be representations and warranties in the agreement. So these are going to be statements by each of the parties about themselves, about the business that's being transferred. This is going to be important in order for each party to get comfortable with certain factual aspects about the other party. There's going to be covenants, so these would relate to things like we're going to use good faith efforts to get regulatory approval, to get member approval, but there's also going to be covenants about carrying on business in the ordinary course, and really trying to make sure that what happens between signing and closing is controlled. There's going to be closing conditions, so certain things will need to happen before the closing can take place. Obviously, there's going to need to be regulatory approval if it hasn't been obtained already, member approval, but this is also an opportunity to make sure there are appropriate protections in place. So, for example, there would typically be a closing condition that there hasn't been a material adverse change, that representations and warranties are materially true, and if these closing conditions are not satisfied, there would not be an obligation to close. And the thing to think about with the closing conditions is that this is really an opportunity for the parties to protect themselves against the risk that something goes sideways between signing and closing. So if you're, for example, a buyer of assets, you need to make sure that you are not going to be required to close if circumstances have arisen that would be overly problematic. On the other hand, there's a tension because the seller is going to really want to minimize closing conditions. Because once a deal's been announced and members have been told that there's a transaction, if that transaction then doesn't close, that has very, very serious implications. It obviously has kind of reputational implications and raises questions about the future direction of the credit union. So sellers are going to want to make sure that once they sign and are public with the transaction, they're going to want to make sure as much as possible that nothing's going to prevent it from closing. The last bullet here is indemnities. So in a typical private M&A transaction, there are indemnities for a variety of things. They might be tied to reps and warranties not being true. They might be tied to certain liabilities or potential liabilities like litigation. The thing to recognize about credit union M&A is that there is going to be a very, very limited opportunity to have any indemnities after the closing takes place. And the reason for that is that if you buy the assets of a selling credit union, there's not really going to be much left behind. So there's not going to be a party standing there with financial resources that's going to be able to stand behind any indemnities. And so really, as a practical matter, you're going to have to find other ways to protect yourself. I will come back to this a little bit later, but this ties into the point about closing conditions as a tool to make sure that buyers protect themselves. So governance, touched on this a little bit earlier a bit when talking about some of the initial steps, but board of directors of credit unions have fiduciary duties. And so they obviously have to grapple with the question of whether this transaction is in the best interest of the credit union. I think that means two things. Is a transaction of this nature in the best interest of the credit union? And is this particular transaction with this particular counterparty in the best interest of the credit union? So there are a lot of considerations that go into that. A couple of them are noted here in terms of impact on members, employees, and other stakeholders. But it's important to have a well-structured process to come to this decision. There's a few bullets here in terms of what should be thought about as part of that decision-making process, right? So obviously there needs to be a business case. People need to think about the implications of due diligence, i.e., the deal might have looked good in the abstract, but once you've dug in and found out more details about the counterparty and its business, what does the deal look like at that point? And then you also got to think about deal terms and making sure that they support a decision that this transaction is in the best interest of the credit union. So due diligence. So when people think about due diligence in the context of say a larger credit union acquiring the business of a smaller credit union, they generally think about the due diligence that's to be undertaken by the buyer. Right? So the buyer is going to need to carry out detailed due diligence, bearing in mind that it's going to be taking over these assets and liabilities. So it's going to need to look at loans, contracts, employment matters, liabilities, whether it's litigation or anything else, and any regulatory issues that they might be inheriting, right? And AML is listed here as an example. I mean, that's one that is increasingly high profile. But those are the kinds of things that the buyer is going to need to look at. And so that's going to require detailed disclosure by the seller of contracts, details about its business, and a detailed review. There also, though, in my view, needs to be due diligence by the seller, right? The board of directors of the seller, as was just discussed, needs to come to the conclusion that this transaction is in the best interest of the credit union. And there's going to effectively be a recommendation to the members that if this transaction goes forward and it's put to them for a vote to approve, there's going to need to be a recommendation to them that they should vote in favor of this. And so there's going to need to be work done and a process that's followed to get to the point where that recommendation can be made. So I don't think this is the same level of due diligence in terms of sort of like reviewing contracts and all that sort of thing, but there needs to be enough work done that you can justifiably reach the conclusion that this transaction makes sense, that this is an appropriate party to enter into this transaction with. So regulatory considerations. So there's going to need to be an approval under applicable credit union legislation. There may also be additional approvals, right? So sometimes there's a transaction and there's a desire to keep the name and identity of the selling credit union. And so there may need to be approvals for the use of a trade name. So people just need to obviously identify what regulatory approvals there are and bear in mind that this is a process that's going to take some time, right? There's a certain amount of time to put the application together, then there's a certain amount of time for review by the regulator. There can also be Competition Act approval. This is not always the case, but it can be the case depending on the size of the transaction. So there's mandatory pre-merger notification under the Competition Act for transactions that exceed certain thresholds. And there's two thresholds that need to be exceeded. There's a transaction size threshold, which is $93 million, and that's really about the book value of the assets that are being transferred or about the gross revenues that are generated from those assets. And then there's the size of the parties transaction, which is $400 million in book value or gross revenue of the parties and the affiliates. So there's an analysis that needs to be done there. And again, this impacts whether a Competition Act application needs to be put together and has some impact on the timeline as well. Although it's been our experience that this is not something that really slows down the transaction because there's other things that have to happen that will take longer than a Competition Act approval. In general, one would not expect to see a lot of substantive competition issues when there's M&A between credit unions. The banking sector is obviously one that's dominated by some very, very large players. And so one would not expect market share to generally be an issue. That being said, there is analysis that needs to be done because the Competition Bureau, will look at sort of niche markets, right? Particular products, particular geographies, and so I think that's something that's important to bear in mind. All right, then there also needs to be some planning about what happens after the transaction. So for the amalgamated credit union or for the buyer, there's obviously the integration of this new business. That can be a significant amount of work. It can also involve transitioning from one banking system to another, and then there's the process of onboarding new members. For the seller, the question is really, if it's an asset deal, you're going to have some kind of shell credit union left behind, and it may have some stuff in it, some assets, some liabilities. So you're going to have to figure out how to deal with that. You're going to have to figure out how to deal with any kind of remaining governance, whether issues like financial statements or AGMs, and then how to get to dissolution. So from a member perspective, couple points here, right? So as discussed, you're going to need to have a member approval of the transaction, and so there's a couple things there. One is you got to think about what the rationale is for members, how to explain the transaction and its benefits to them, and then there's also a process for calling and holding the meeting, right? So there's going to be a notice of meeting. It's going to have information about the transaction, enough to allow them to form a reasoned view on it. And then you got to also think about how you're going to deal with membership transfer, right? So there's a couple points there that can be a little bit tricky, right? So one is that there can be different minimum values in terms of the member shares of the parties, right? And so you're just going to have to think through how that's going to work. And the other point is, so member shares and membership is one thing, but if there's investment shares, you need to think about how those are going to be dealt with as part of the transaction, right? So in an asset transaction, there's not a straightforward way of having the investment share capital move from the seller to the buyer. In my experience, there are some mechanisms and steps that can be used to try to move that share capital over, but it's not straightforward. And that's something that's going to need to be thought about at the outset. So one of the key questions at the outset, when I'm involved in one of these transactions, is always, are there investment shares? All right, so the last slide here, issues and challenges. So the first one here is time and resources. So I think it's important to understand, if you haven't undergone one of these transactions before, that it is a complex process, and it does take a lot of work, and you can try to get it done quickly and efficiently, but it is going to take a certain amount of time, and people need to kind of wrap their head around that. We talked about some of the steps, right? But there's due diligence, there's negotiating an agreement, there's dealing with the member meeting and approval, there's regulatory approval, there's dealing with the closing, there's dealing with HR issues. So all of this is a lot of work, and you got to think about how you're resourced to do that. How the buyer can protect itself against the risks of the transaction. Again, there's going to be limited ability to get any kind of indemnity protection after closing. So really, this is going to be about due diligence. So due diligence is critical. And then it's also important to have appropriate protections in the agreement in terms of closing conditions and that sort of thing. Liquidity and risks to the seller. So the selling credit union needs to be sensitive to is that once this transaction is made public, there's going to be potentially a reaction by members, right? And so the risks are, for example, members don't like it, members start to leave. These risks are attenuated if the transaction is announced and then doesn't close. So these are things that people are going to need to think about. Managing change in identity. This is something that this needs to be thought about. It has implications for members. It has implications for employees, but this is a big change for people. And so there's obviously got to be thought given to how to manage through that. And then cross-border mergers. So I'm not going to talk about that. Victoria, I think, gave a very helpful overview of that. And then I'm just going to end with a couple sort of comments on pitfalls and tips. And I think one of the things that people want to do when they've decided to enter into one of these transactions is they want to get it done as quickly as possible. And that's understandable, obviously. So my thoughts on that are as following. Number one, be realistic about how long it's going to take, bearing in mind what needs to be done and what your resources are. Number two, this one might sound self-serving, but I would say get legal advice. And get legal advice from people that have experience with credit union matters, because it's not the same as any other M&A transaction. Three, ensure that you have a very clear and well-articulated business case. This is going to serve a number of purposes. It's going to help drive the decision by the board of directors to enter into the transaction. It's going to help you communicate the rationale for the transaction to members, and it's going to help you explain it to regulators and get the approval you need. And then finally, when you're dealing with regulatory approval, make sure that you've got a clear and comprehensive application that addresses all the elements that it needs to address. I think that the way to deal with regulators efficiently is to make sure that you really kind of lay it out for them in a clear way. and lead them by the hand, as opposed to giving them half-formed applications and then having them come back with follow-up questions. That just slows down the process in my experience. So those are my comments, and I will now turn it over to Mehrdad.
All right, thank you, Koker. So as you probably know, Monday was Blue Monday. That was 3 days ago. If you don't know what Blue Monday is, it's deemed to be the saddest, most depressing day of the year. Now, Koker, knowing this, organized this event for this week, I think, so that we can get through this very miserable week together. So thank you very much, Koker, and all your Fasken colleagues for organizing this. And thank you very much for everybody who's come in person to attend and they braved the cold. And also thank you very much for everybody that's joined us online. I'm going to read something that I kind of looked up today, and I know Jeff Guthrie is here with us as well. He's brought these principles up in the past, and it left an impression with me. I've known them for many years, and they never get old. So the 7 cooperative principles were articulated 180 years ago, and cooperative principle number 6, it's called cooperation amongst cooperatives. I'll read you a part of the description as it's articulated, not the entire thing. So while co-ops are independent of one another and run by autonomous individuals, they also need to work harmoniously together. Creating a larger network of cooperatives locally, regionally, nationally, and even internationally allows independent organizations to serve their members better. Each co-op brings unique abilities and contributions to the table, and they function with more strength as a unit. So very wise words, and as applicable today as they were 180 years ago. I mean, we all know that the environment is very complex. Victoria very clearly articulated this, given the volatility, the change, the modernization, the complexity, and it's going to get more complex going forward. Things like technology, digitization, AI, payments modernization, real-time rail, consumer-driven banking, all of these things are introducing risks, they're introducing costs, but at the same time, they're introducing opportunities. So given this environment, FSRA, and I can only speak for the Ontario regulator FSRA, has introduced and implemented a new regulatory regime over the last 5 years to make sure that the regime is current and fit for today's environment to enable credit unions to remain strong and sustainable, competitive, and innovative. So my team has been very involved over the last, especially year. We've been very focused on strategic planning, governance, and ultimately long-term sustainability of credit unions. So the title of my presentation actually is that. I think it's called Strategic Planning and Long-Term Success, but I didn't label it that there. So given the operating environment, while each credit union's environment is somewhat different, they're all impacted by a core set of common factors. And, I should advance the slides.
Good, I'm not the only one.
I totally forgot. So we've just listed some of them here. Of course, this is not a comprehensive set. I'm sure you can come up with some other ones as well. So with demographics, population growth, immigration, and changes to the workforce, we certainly experienced that significantly in Ontario. Economic growth, economic shifts in local markets, and given, who knows whether there's going to be tariffs or not, or the renegotiation of NAFTA, these are going to be very impactful as well. Evolving consumer preferences, and ultimately everything credit unions do is really to serve their members best. So you got to meet your members' demands. And again, the demographic is changing, so how these members are going to want these products and services delivered is going to be different. Technology delivery. This is very significant, especially now, given various technology platforms, and the second tier of the credit unions right now is in flux with things like Forge and Member Direct. Lots of significant changes going on in the credit union system around technology. Competitive pressures, climate change, that's prevalent globally. You can't escape it, doesn't matter where you go. And regulatory evolution. This is material changes in regulation. And like I said, we didn't change the regulatory regime to make work for ourselves and to make work for credit unions. We changed the regime to ultimately meet our objects, which drives our mandate and what we do. And one of our objects is to ensure the sustainability, the strength, and competitiveness and innovation of credit unions. So you've heard about principles-based regulation. This presentation is not going to be about PBR, principles-based regulation, but PBR is part of this regulatory regime that we've created over the last few years to give more flexibility for credit unions to be able to deal with this very complex and modern environment. But as was mentioned earlier, anytime you introduce something new, you're trying to build something new, enhance something, it will come with work to begin with, but ultimately in the long run, we think that this will benefit credit unions. Regarding long-term sustainability, like I said, we're focusing on this and have been over the last year. Credit union senior management, they are responsible for planning and delivering a credible strategy that adequately considers the challenges and opportunities facing credit unions, the ones that we've been speaking about. So we specifically mention credible strategy and not just strategy, because just something called a strategy is not good enough. It needs to be credible. It needs to be comprehensive. It needs to be sufficient. It needs to be implementable. And it needs to consider timeframes, so the short term, midterm, and long term. So some strategies that we've seen, they're very one-dimensional, or they don't consider the longer time period. And given this environment, although it's very difficult to predict what's going to happen 3 to 5 years from now, that is a consideration that senior management and board have to take when developing their credible strategy. Regarding the credit union board, the board is responsible for defining long-term strategic direction and goals. They cannot delegate that to senior management, although it is tempting because the board doesn't have as much time as senior management, so they tend to delegate this. But this is something that the board really needs to take accountability of. It really is their accountability. But throughout the implementation process of the strategic plan, which is delegated to senior management, the board should continuously seek assurances that senior management is going in the right direction along that strategic direction that the board has set, and they're achieving the goals effectively. So this implies that the board is not just involved at the end in some couple of strategic planning sessions at the very end, but from the very beginning to meet amongst each other, meet with senior management, set the strategic direction and goals, and then throughout the process, throughout the months in developing, where senior management is developing the plan, check with senior management and make sure that there's no divergence, that ultimately you converge on that credible strategy. Like I said, the board is ultimately accountable for the credit union strategy, and the plan must consider the impact of longer-term challenges, risks, and opportunities, like we discussed in the previous slide. Regarding the regulator, and Koker mentioned this, he put it very well, the better the regulator understands the credit union strategies and plans, the better it can implement an efficient and effective regulatory regime that supports the credit union and the credit union sector. Some questions to ask regarding long-term sustainability. What are the long-term challenges and opportunities facing credit unions? And we've discussed some of them. Now, this is what senior management and boards should do. And again, boards shouldn't just completely delegate this to senior management. How is the credit union strategy currently aligned with these issues? Is cooperation with other entities required? What are potential models to face these challenges cooperatively? And we're going to talk about some of these models in a couple of slides. And how can the regulator foster and support credit unions as they develop these new solutions? Earlier on, Victoria mentioned this, and she talked about an imbalance between regulators focusing on financial stability, which is one of our objects and it feeds our mandate, but specifically for FSRA, one of our objects is also to promote strong, sustainable, competitive, and innovative financial services sectors, including the credit union sector and credit unions. So that is something that we're working on. We're trying to create that balance, but you can understand why you need to have a balance. If you just innovate and compete, and you're taking on excess risk that you're not getting rewarded for, and you're not protecting the credit union and its members, that can lead to crises and issues that we want to avoid. These potential shared solutions that we were talking about, now I said that over the last year we've been talking very closely with our sector and our sector stakeholders, and some of the ones that they're currently talking about, I mean, I don't think any of these are really new, but credit unions are currently looking to how do they reposition themselves to meet these current challenges and take on these kind of new opportunities while they manage the costs and risks. And we all know that at some point you're going to need some sort of scale to deal with this. And so conventional mergers, obviously that's an option. Smaller credit unions merging into larger ones, but also larger credit unions merging into other large credit unions. We're currently working at FSRA to make it easier for smaller credit unions to merge into larger credit unions. Now, I wouldn't say there are impediments, but it is a very slow process. It is drawn out. And what we're trying to do is expedite that process. So, for example, if there's a $5 billion credit union that wants to acquire a $300 million credit union, that should be a faster process than it currently is, and we're currently working on that. Federal mergers or acquisition, we've touched on that. I'll speak about this a little bit earlier. On the provincial side in Ontario, there isn't an impediment currently for a provincial credit union to sell its assets and have its deposits acquired by a federal entity, not just a federal credit union, but also a federal bank. But there may be other impediments on the federal side, and definitely there are impediments in some other provinces as well. Alliance mergers, this is, for example, ethno-religious and community-based credit unions merging into a single entity with shared central services and highly customized subsidiaries or business units. This shares characteristics with both what we've seen with the multi-brand model. I think First West is using this model in BC, and of course the federated model, which Desjardins is using in Quebec. This is, and a few of our credit unions are currently in Ontario exploring this, and this is ultimately to maintain their identity, because if you're Ukrainian or Lithuanian, you don't want to lose that identity and that connection to your community, but you may not have that scale and the expertise and be able to manage the costs of back office services. So you may want to merge into this kind of an entity to gain scale, but to still maintain your identity. So this is something that we're working on with credit unions right now, and it could possibly be a solution. Federations, this is for independent or semi-independent credit unions with a shared back office. We know about this. The best example is Desjardins. The central entity provides a standard set of services, allowing credit unions to focus on sales and service, especially if you have a branch network, you want to focus on your members, and that's what you're good at, the sales and service. But then on the back end, again, you're getting that scale, you're sharing the costs. But things to really have to manage very carefully is the level of integration, the shared governance, and that's usually what gets in the way of this model. And of course, the funding model, who's funding what and when. QSOs, we all know about QSOs. There are a lot of them in the States. Credit Union Service Organization, again, back to shared back office solutions. So a QSO would need to choose an ownership model that balances cooperative principles with the need to streamline decision-making and access the required funding. And then there's, of course, strategic investments and joint ventures. This would be individually or collectively to either acquire another entity that provides the services or stand up a new entity. So this would be for things like wealth management, insurance brokerage, leasing company, payments providers. Other options, of course, are federal continuance, so a credit union could continue to the federal regime and merge with other federal credit unions, or as some of our credit unions have in Ontario, obtain a license to operate a federally regulated subsidiary, like a federally regulated bank. That's another option to expand and gain access to the federal regime, to the Canadian regime, without the parent, the credit union, leaving the provincial system. Now, FSRA is very open to innovation and modernization. So these are just examples that I brought up. This is not a comprehensive set. We absolutely encourage credit unions to come to us with any other solutions that they have, even if they think there are impediments, even if they think it may not be possible. Please bring it to us. Let's discuss it. We may find possibilities and solutions. Like I said, we're open to new ideas and innovation. FSRA has an innovation office. And what this is you've probably heard of regulatory sandboxes. We have within the innovation office a test and learn environment. What this allows is to give time-limited exemptions. So there may be either perceived or actual impediments to provide new services and new products. So in this particular controlled environment, we can, like I said, in a time limited, provide exemptions to these impediments which would allow for live testing of these products and services. And ultimately, if that's a viable and a credible idea and is well tested and the risks are mitigated, we can actually remove those impediments and you can take this to market. So, but within the credit union sector, now this is for all our sectors, but within the credit union sector, our act, the Credit Union Case Popular Act, is actually quite flexible. And I'll talk about this in the next slide. Although the Innovation Office is a great mechanism to use, we may not even need to use the Innovation Office, and I'll talk about this in a minute. A little bit on, and this is the last slide, a little bit on our approvals process, the FSRA approvals process and how things work. Koker has touched on this, and he summed it very well, but our process is integrated, so it's not just one team that looks at this. We have an approvals process that looks at these kinds of transactions like mergers and acquisitions and asset sale and purchase, even federal continuous, that goes to the approvals team for recommendation for ultimately approval. But you would also have to deal with the Prudential supervision team and the market conduct team as well. Now, for example, with market conduct, what would they do? That team would review content, delivery channels, and plan timing for information that would ultimately be provided to members. In FSRA's case, because we have the dual mandate of Prudential and market conduct, including consumer protection, we have the market conduct team involved as well. So communication is key. Communication with the market conduct team, the approvals team, and the supervisory team early. Don't wait to the end. And I say this because we're experiencing right now credit unions that bring us transactions either incomplete, like Koker mentioned, or they bring it to us late. They're disappointed. Their timelines are not met. So if you bring it to us early and you bring us through the process and you get our input through the process, by the time you get to near the end, you will most likely be met with that particular timeline. So that open dialogue early on, bring us in very early on, that is something that we highly encourage. Regarding application criteria, we have published a document that lists all the criteria. I've just listed a couple of them here. It's actually an approach guidance document. It's called the Approval or Authorization of Business and Investment Activities under the CUCPA, the Credit Union Case Popular Act. Some of the key things that I've highlighted here are clear benefits that are in the best interest of members. That needs to be very clearly articulated. It has to be what's best in the best interest of the members. Appropriate due diligence and analysis of risks. What we see in a lot of the applications is that the benefits are well articulated, but some of the risks are not identified, and if they are, they're not well analyzed, and the plan for how to mitigate them is not well articulated. So make sure that you focus on the risks as well. And obviously having a business plan with respect to the transaction that is sound and feasible, and also making sure that that plan is aligned with the larger business plan and the credible strategy and the governance frameworks of the credit union. So back to the legislation which I was talking about, the Ontario legislation, the CUCPA, does not limit transactions, including mergers and acquisition, including selling assets and acquisition of deposits, the acquisition of deposits. It doesn't necessarily have to be to another provincial credit union in Ontario. It could be to another credit union, either in the federal realm, or it could be another federally regulated financial institution. So those impediments currently aren't there because of the new act that's in place. A few years ago as well, before the CUCPA was updated and put into force in 2022, early 2022 is when it came into force, credit unions expressed the need to expand business powers, and they felt they needed to do this to compete effectively. So the ministry updated the CUCPA, and like I said, it came into force in 2022, and it's section 139. And what that allows is for, with FSRA's approval, for Ontario credit unions to engage in any business activities that are currently not authorized in the Act. Currently, no credit unions have come to us, and this is why I say we may not even need to go to the Innovation Office. This may be something that we can work together through the supervisory and approvals team, remove impediments, and you might be able to deliver that product or service in a timely way. But there's also the Innovation Office mechanism that could help as well. So I'm going to go back to the cooperative principle number 6. Let's cooperate, collaborate, work together to make sure that credit unions are strong, sustainable, innovative, and competitive. Thank you.
Thank you, everyone. We're going to turn now to the question and answer section. Folks that are online, you're more than welcome to submit a question into the chat or the Q&A, and we can see them here. For everyone who is attending here in person, put your hand up, we'll bring a microphone to you, or I'll do my best to repeat your question. We also received some questions from guests when they registered, so I'm going to start things rolling with those ones, and we'll see what other questions that we actually might get in. First off, and all of you have touched on this a little bit, but just to ask you to go into it in a little bit more detail, I'm going to go from Victoria to Koker and then down to Mehrdad. What is your perspective? So share a little bit more on your thoughts on federal credit unions. What are the opportunities or benefits that it opens up?
I'll start with one of the basic benefits, which is the ability to not only attract members, but to serve members across the country. And one of the big things that cannot move when a credit union member moves from one province to another is their mortgage. So for example, if you only operate within a particular province and your member chooses to leave that province, there will be issues with porting that mortgage. If you're a federal credit union, you don't have those issues. You can operate freely across the entire country. I think there's also benefits to knowing the full parameters of what your regulatory environment are and having the access to capital that you have when you're federal.
Thank you. Koker.
Yeah, so I mean, I think there's really kind of two points that I would make. So one is obviously it does open up the market, right, in terms of where you can carry on business. I think this has been well covered. And then from a business combination or M&A activity, you know, it obviously opens up the possibility of having mergers or having acquisitions of business that are crossing provincial lines. So these are the I think, you know, the possibilities that it opens up. You know, I think that just a couple other comments I would make is, you know, there's also other things to think about, of course, right? So one is, you know, you are moving to OSFI regulated regime. Obviously, credit unions are prudentially regulated at the provincial level, but it is a different regulatory environment. That's obviously got a lot of implications. And then, you know, I think the other question is, okay, so you now have the opportunity of accessing these additional markets, but how are you going to actually do that? Because I don't think it's necessarily it's not that easy to be a small bank in Canada. It's competitive not just within provinces, but at the national level. So I think, you know, there's still a number of questions that need to be thought about.
And Mehrdad?
All right, thanks, Sarah. So federal continuance, and I've mentioned this, it's one of many options that's available to credit unions. And so I'm speaking from the regulatory perspective. What we want to see is that credit unions have actually explored other options, that they don't say, my strategy as the credit union is to grow. My strategy as the credit union to go federal. That's not a strategy, right? That may be a plan that fits into your credible strategy, but the strategy has to be something else, and that's what we mean by credible. So if that's the case, if ultimately it's one of the plans that fits into the credible strategy is to continue, then that's fine, but it has to be compared to other options as well. Another thing is that ultimately this needs to be driven by the board. What we're seeing currently is these types of talks are usually driven by senior management and CEOs, but the ultimate accountability of strategy and the fiduciary duty of the boards is to make sure that it's in the best interest of the members. So that really sits with the board. So boards need to get involved, and they need to get involved early, and they need to talk to other boards as well. And so don't just look at one option, compare all the options, and really take a decision that is best for the membership. And in terms of on the regulatory side, yeah, there's an approvals process, but like I said, we view things through the lens of our objects. And as I've stated, there's a balancing between financial stability of the sector and also promoting competition and innovation in the system to make sure that the credit union is long-term stable.
So here's a very practical question that's come in. So Koker, I'm going to ask for your thoughts on this one. Can you speak to any challenges in balancing operational business as usual versus controlling activities that you've touched on in your presentation between the signing and the closing? What sort of practical challenges have you seen in that?
Yeah, so I think this ties to the comments I made about interim period covenants, right? Where there's going to be commitments to carry on business in the ordinary course. So I would say that in transactions, these are provisions that people need to look at pretty carefully, and it is a balancing, right? I think there's a couple kind of principles, right? I think number one, for sure, the seller needs to be able to just carry on its business in the ordinary course. The gap between signing and closing, people want to do things quickly, but we're talking about at some number of months, generally, and so you need to make sure that you can carry on business. I think from the buyer's perspective, they obviously want to make sure that the credit union that they're doing a deal with at the end looks pretty similar to the one that they entered into the agreement with, right? So, big material changes, those are the kinds of things that you're either going to commit not to do, or you're going to commit not to do them without approval of the other party. But you have to make sure that the constraints aren't too tight, because fundamentally the credit union needs to continue to carry on business, and it also needs to be able to carry on business in a way that will be sustainable if the deal doesn't work, right? You can't put yourself on a kind of a one-way track towards doing a transaction, and if the transaction doesn't happen, you're going to have a huge problem. You need to put yourself in a position, if you're the seller, where if the deal happens, great. If the deal doesn't happen, we've continued to operate our businesses in a sustainable way, and we'll be able to continue.
And our next question, which is for all of you, I think also relates to one aspect you touched on your presentation for that last one, Koker, around people, the difficulties of managing a transaction and going through all of it when you have a limited number of resources to be balancing business as usual while preparing for the closing. The next question is there room for smaller credit unions, or are the pressures for scale too great for them to be sustainable? So Victoria, you touched on this, so I'll let you lead that off.
Fantastic. I may get myself into some hot water here. Yes, I think there is room for small credit unions, but how do you define small? So you need to be big enough to still serve your members, still meet the regulatory environment, still meet the technology demands. I think one of the real strengths of credit unions, which Mehrdad has touched on, is their ability to really understand their communities and really understand their members and really serve them specifically. And there are risks that some of that may be diminished as credit unions get bigger and bigger. So yeah, I think there is space for credit unions, but to Mehrdad's point, you need to have a credible strategy for how you're going to survive if you want to stay small.
Koker?
Yeah, I guess what I would add to that is, and I think, I think that question sort of holds with respect to deposit-taking institutions, generally, right? I think banks face the same question, right? And I think, what I would say on that is that if you're going to be small, you better have a niche that you're playing in that's going to allow you to be successful, right? I think it's going to be very, very difficult to be a small credit union that's just trying to do the same thing that everyone else is doing. Because you're going to have a different you're going to have challenges with your margin. So so I think there is room for it, but I think that the degree of difficulty is higher.
Thank you.
There's absolutely room for smaller credit unions, and we see in certain rural communities where the only financial institution is a credit union, and part of the vision of FSRA, it's very clearly articulated, is choice for Ontarians. And Victoria, you mentioned this earlier, that's an important role that credit unions play. So FSRA has never taken the position that all small credit unions must disappear and merge into bigger ones. We would like to continue to see these credit unions serving their membership in their communities that currently are not served by anybody else. But if they continue to do things, some of them, if they continue to do things the way they're doing now, the cost pressure is just too high. So that's why I was mentioning some of these models. Some of them are old models that people have known that exist for a long time. Maybe some are new, and there might be ones that people can come up with over the next few months and couple of years to address this problem, where a small credit union can maintain its identity, but ultimately reduce that cost burden by working with other credit unions. And that's why I keep talking about collaboration and cooperation. I mean, these are credit unions. They should be very good, and have been in the past, at cooperating and collaborating. To find that scale, especially on back office services and these costs, to find that skill but still maintain their identity. So there's room. It's difficult, and it's going to get more difficult. So that collaboration is going to have to will become more important.
Well, you've just touched on demographics, and that's one of the other questions that we've received. So first off for you, Victoria, because with your background with CCUA, I think this may help to answer it, and then I'm going to turn to Koker and Mehrdad. So for Victoria, what are the ways that you use? What are sort of the research that CCUA looks to in really thinking about demographics and where things are going? You provided us with a lot of information today about that. And so how can credit unions really be thinking about data-driven, thinking about where they can look for that information?
CCUA has a research department, and we also access research from external sources. So in many ways, a lot of our members can look to us. They can also access the research that we provide to our membership through their membership dues and the access they have to that. So that's how you can find out what the demographic issues are. But I think there was a second part of that, which is how do you attract?
There is, exactly. And I'm going to toss that down the table if you want to pass on that.
No, I'll answer. I'll start with an answer, and then I'm sure there will be additions. I think one of the big issues that credit unions are facing right now is that one of the distinguishing elements of the credit union sector for a long time has been their focus on community, their focus on the environment, their focus on sustainability. And all of these things really are important to younger demographics and to younger Canadians. However, we're finding that they're less important to younger Canadians than fast digital services. So there has to be a balance between those two if you want to attract young Canadians who live in a digital world and expect to have everything at their fingertips and relatively frictionless.
So Koker, in the question related to this is, during mergers, how important is it to understand demographics and market?
Yeah, I think it's obviously very important. And it obviously speaks to the question of why are the parties looking to enter into this transaction, right? So if you're a larger credit union and you're looking at the smaller credit union, I mean, I guess you might be just looking at it as some way to add incremental size, but chances are you're looking at it saying, is this giving us access to a membership base that we don't currently have a relationship with, right? So that might be about demographics, but that also in a lot of cases is about geography. So I think that's important. That's going to be part of due diligence. And I guess the other thing that I would just touch on, just building on some of the comments that Victoria made about how to attract new members, is that I think that is an important consideration for a lot of smaller credit unions that are considering business combinations, which is given the resources they have, it can be very difficult to provide the services that are required to attract new members, right? So it can be difficult to make the investments that are necessary for digitalization, and you might have a limited offering of products and services compared to larger credit unions. So I think in some cases, that ability to attract new members, is challenged by size, and that could be a driver as well.
And Mehrdad, demographics and market, how does that factor into regulatory decisions?
Well, I mentioned this earlier, how demographics is one of these things that the senior management and board need to consider when they're developing their credible strategy. For long-term viability, especially now, I don't think you can be long-term viable if you don't consider demographics. How are you going to attract 20 and 30-year-olds if you don't have these ways to provide these services? Like Victoria said, faster, better security, cheaper. So you can't do this on your own, and that's where the collaboration comes in again. I don't think, there could be some very large credit unions that may be able to do this on their own, but I think generally most credit unions cannot do this alone. They need to collaborate, and they need to figure out a way how to create these back office services that can ultimately reduce costs, bring the scale, so they can actually meet the demands of the new demographics.
So a related question just came in for you, Mehrdad, which is, can you comment on how collaboration can work together when credit unions are actually competing with each other?
Right. Well, just look at the kind of the end game. You're either going to exist or you're not. So if you say, well, I'd rather collaborate and exist with potentially what you consider to be one of your competitors, as opposed to I'm not going to exist 5 years from now, I think that makes it easier to decide to work with some other credit unions. Now, this is nothing new. Credit unions have done this in the past. They've worked together in the past. So I don't think this is anything where people have to imagine something that they haven't seen before, right? This is something they've done. Yes, okay, some of the main competitors to credit unions are other credit unions, but at the same time, if you see the end point and you see without that collaboration, you're not going to exist. I think then that opens your mind up to finding innovative ways to collaborate with each other. Maybe compete, but you may also have niches where if you're smaller, you maintain your identity, you serve your the particular demographics or your community or your membership, but at the same time, you bring that scale and you reduce the cost of those back office services. So there is a way, and I think the biggest reason, that's why I kept talking about the cooperative principles and the collaboration, is if I had to choose one thing that's getting in the way of the credit union system doing well going forward, it is this. It's the lack of collaboration. It's egos getting in the way. It's people being afraid of, I don't want to deal with my competitor. That mind state needs to change.
Thanks. Well, we have a question here in the room.
You talked a little bit about federal credit unions and provincial credit unions and some barriers to amalgamations or mergers. There are some small banks that are smaller than large credit unions, and some of them are maybe regionally focused or they have a specific niche. Are there any regulatory impediments to those kinds of mergers, maybe between a large federal credit union and a small bank?
Koker, did you want to start with this one?
Well, I'd sort of make two comments, right? So, if you have a credit union merging with a bank, there's obviously the issue that one of these is a cooperative financial institution and the other one's not. So you're going to have to figure out how that's going to work, because it is different than having two cooperatives merge. I think at the end of the day, there are ways to make those sorts of business combinations work. But it does raise some additional complexities, and there is this question about what is the goal here? Is the goal to have the federal credit union acquire just grow and acquire the business of the bank, or is there some other objective in terms of the end state?
Mehrdad, did you have any thoughts on?
Well, I have thoughts, but that's a federal regulator question,
Yeah.
so it's best for me not to answer and let OSFI answer that question.
Okay, thank you. We're down to our last 10 minutes. We've focused a fair bit on questions in terms of operations, specific small credit union questions. I'm going to broaden things from a different perspective from another question that came in earlier from registrations. How do you see open banking or payments modernization creating opportunities for credit unions? And Victoria, I'll ask you to start and then continue to Koker and Mehrdad.
One of the ways from open banking, and there have been a number of presentations and a number of materials that CCUA has provided outlining some of the benefits of open banking and some of the business cases of open banking. But one of them is that you can offer your members products and services that you can't develop on your own. So you can really open up the opportunities of what you can provide and how you can serve your membership.
Yeah, and I guess just the general comment I would make about those initiatives, about more generally about technology-related developments, is that I think that it does create opportunities for credit unions. Obviously, there's new things you can do. There's new opportunities to partner with ways and people you haven't done before. But I think there are also some challenges or some threats, right? Which is that these also create opportunities for other people. And I think what we've seen over the past while is that one of the things that technology has done is it's created a broader suite of competitors in the financial services space. And so I think there are opportunities, but I think there's also threats.
Yeah, not to repeat what's already been said, but it's absolutely possible for this mechanism to provide credit unions access to a level playing field with other financial institutions. I've talked to Jeff about this. I've heard some credit unions having concern that they need to go to the federal regime to gain access to consumer-driven banking. That's absolutely not true. I've talked to the senior management team at Payments Canada, Bank of Canada, FCAC, and Federal Ministry of Finance, and they've all assured me they're committed to make sure that provincially regulated credit unions will have access, if they meet certain criteria, will have access to the ecosystem. So we've been working for a couple of years now in anticipation of this particular mechanism being available. Now, with all that's going on in politics right now, it's going to be probably a little bit later than we expected. But once it becomes available, and it will, there are going to be certain criteria that the Canadians are going to have to meet. So, like I said, in anticipation, we've been working to put the things in place and prioritize work. For example, we published an operational risk and resilience guideline. We've pursued a very kind of aggressive data strategy. So people may think, oh, that's just regulatory burden. That's just for the regular. It's not. We actually prioritize it thinking, what will credit unions need 3, 4, 5 years from now? How sophisticated do they have to be to participate in this ecosystem? So once they get there, I think people will realize, oh, I'm glad those were put in place. I'm glad we're aligned with those particular guidance and direction and standards, because then they would qualify to participate in that ecosystem.
Thank you. I'm sorry, Mehrdad, you just finished, but another question for you.
Yes, absolutely.
How should credit unions approach their relationship with their regulator? And then Koker, I'm going to ask you for some practical suggestions.
Easy, that's an easy one. And I mean, part of it is with us too. So the trust has to be built, and it's bi-directional. So I can't just say, trust the regulator. Well, I don't know, you got to gain my trust, right? So we got to do the right things repeatedly, consistently. And it can't just be me, it's got to be everybody at FSRA. And but once that trust is gained, and that's what we're trying to do right now, open, transparent, timely communication. Koker mentioned it earlier. That's what it's about, open, transparent, and timely communication. The earlier you communicate your ideas and thoughts, the better we can help you. The more we start to believe that you trust us, so it's going to be a lot easier for us to have that bi-directional trust. And we can potentially remove impediments. I mean, if we can, and if it's warranted, we will remove impediments. That is a desire that we have. We want to make sure that credit unions, like I said, are long-term sustainable. It's within our objects. It is our mandate. That's why we exist. And we want to make sure credit unions have been around for more than 100 years. We want to make sure they're here for the next 100 years, even though I won't be alive for it. So when I say open, just to describe what I mean by open, you need to be open to new ways of doing things. You need to be open to new ways of interacting with your regulator. You have to come in with an open mindset. I've dealt with some very intelligent people that are very experienced, and it doesn't matter what I say to them, they come in with a closed mind. And if you come in with a closed mind, you can spend hours with them. You go nowhere. So you have to come in with an open mindset and allow a new kind of way, a new relationship to form. So that's what I mean by open.
And I guess, just a couple of points that I would add are, I think that the relationship with the regulator is something that needs to be proactively managed. I think that, the risk, I think, for institutions is that if they're in a bad place in terms of their relationship with the regulator, everything is more difficult. And people have very different experiences in terms of dealing with their regulator, depending on whether there's a degree of confidence and trust or not. So I think that, as Mehrdad said, building that relationship of trust is important. And to do that, I think it's important to be transparent. Obviously, to manage your relationship with the regulator, but I think you do need to be transparent and to be seen to be transparent. And you need to think about what their drivers are, and make sure that you are conducting yourself in a way that meets their objectives, and if there's things to talk about, talk about them. I think that my experience has been, certainly with the regulators that I deal with, that they generally are open to communication, they are open to collaboration.
Like Koker, you deal with regulators across the country. Victoria, so do you have any thoughts on that?
I do, absolutely, and I would agree with everything that Mehrdad and Koker have said. I think it's really important for the regulated to remember that the regulators aren't your enemy. They also want the sustainability and the long-term success of your institution and of the sector. And the rules and the regulations that they're putting into place are designed to achieve that. And at times, maybe they may be a little too heavy, maybe they're not perfect. That's where that dialogue is really important. The regulator needs to know why it's a burden for you, why it's actually not achieving the result that the regulator might want. And you only get that if you have a really good and transparent relationship with your regulator. And I would add to that in the areas that I've seen where there are those good relationships and that good dialogue, the legislative environment actually often, as Mehrdad indicates, changes to make things easier for the regulated entity. So it's a very, very good thing to have that good dialogue.
Thank you. I think we have time for one last question, so I'm going to pick one that really, I think, pulls together a lot of what everyone has said today. It is, what should a credit union, whether a buyer or seller, keep in mind before a possible transaction, from a legal perspective, from a regulator's perspective, and from a strategic perspective? So Victoria, I'll ask you to start and then continue to Koker and Mehrdad.
I'll start with a very simple thing, which is how is it going to help your members? How is it going to help your long-term sustainability, and how is it going to help your ability to serve your current members, to find new members, and to be meaningful in your community?
And I guess, sort of at the sort of practical level of how you're going to execute this, I would say make sure you understand what the steps are, what's involved. It is a lot of work. It's often a lot of work on the part of people whose day job is running a credit union. So figure out how you're going to do that. Make a plan. Make sure you're adequately resourced and are realistic about what the timelines are going to be.
Completely agree with what's been said, and Victoria said it really well. To be able to do what's best for the membership, for the long-term sustainability of the credit union, so you can continuously provide these good services to your membership and community, you need to explore different options. You need to speak to different people and different credit unions, especially the boards. Something that we would like to see is boards talking to more boards, exploring different options. Options are good, right? Options are good. Possibilities are good. So I think the more you get that dialogue between boards and, of course, senior management who are more active, the better that would be ultimately in deciding what is best for the membership. And it's already been said, but bring the regulator in early as well. We see patterns. We talk to everybody in the system, whether it's stakeholders or boards or senior management. We may be able to provide information that may be helpful to provide some information on some options or what others have done that you may not know, or even connecting you to those that are thinking similar things and similar options or innovative options. So talk to us as well.
Well, thank you. And that concludes our event for today. In closing, I want to thank all of our speakers and all of our guests for joining us in person and online today from across Canada. For those of you who are concerned about CPD, you'll see that there are links for the Law Society certificates on your screen. For our BC viewers, the Law Society of BC title has already been added to the chat. Thank you for coming today, and we hope that you all have a great afternoon. Have a good day.